You're seeing them everywhere. Sleek, affordable electric cars from China. They look modern, come packed with tech, and cost thousands less than anything from the West. But what if these bargain EVs are more than just a good deal? Could China's aggressive EV export strategy be a brilliant economic move? Or a Trojan horse threatening global security and the world's auto giants? Let's find out. And you might just rethink everything you thought you knew about your next car. China's rise in the electric vehicle market didn't just happen by accident or luck. This was a carefully crafted national project. A 15-year marathon of policy, subsidies, and sheer industrial muscle. Back in 2009, Beijing identified electric vehicles, or as they call them, new energy vehicles, as a critical national industry. And when China picks something as strategic, it doesn't just talk about it, it builds it. Over the following decade, the government poured more than $230 billion into the sector. That's everything from direct subsidies for buyers, tax exemptions, research grants, factory loans, to huge investments in charging infrastructure. The result? A hyper-efficient, vertically integrated system where companies like BYD and CATL control the entire supply chain, from lithium mines and battery chemistry all the way to the finished car. That vertical control is the secret sauce. It allows Chinese automakers to produce a modern electric car at a price point that Western firms simply cannot match. Even after adding shipping costs and tariffs, they still come in cheaper and often by several thousand euros or dollars. For consumers, that's a dream. For Western automakers, it's a nightmare. Before we go further, if you're enjoying these kinds of deep dives into how economics and geopolitics collide, make sure to like this video and share it. It really helps more people find and join the conversation. Inside China, the EV market is actually overcrowded. Factories can build nearly twice as many cars as Chinese consumers are buying. That's led to an intense, almost brutal price war at home. So these automakers have little choice. They must export or die. And that's exactly what they're doing, flooding foreign markets with ultra-competitive models. In Europe alone, BYD, SAIC, and Geely are now household names, and their market share is climbing every quarter. One analyst summed it up perfectly. China subsidizes production, creates massive scale, kills off weaker domestic competitors, and then sends its strongest champions abroad, armed with unbeatable prices. It's a strategy that's both brilliant and ruthless. For consumers, the short-term picture is fantastic. Finally, electric cars that are affordable. You're not paying $50,000 for a basic EV. You're getting smart tech, good range, and all the bells and whistles for nearly half that. But for traditional automakers, this is an existential threat. European giants like Volkswagen and Renault, or American icons like Ford and GM, are suddenly facing competitors that can sell cars below their production costs. Analysts warn Europe could lose up to 2 million sales to Chinese brands in the next few years. That's not just about profit margins, it's about jobs, factories, and national industries. Germany, France, Italy, all depend heavily on automotive manufacturing. And when you combine declining sales with overcapacity in European plants, you get a dangerous mix. Layoffs, plant closures, and even the potential hollowing out of entire industrial regions. So the cheap EV isn't just a product story, it's a geo-economic one. Because cheap cars are one thing. But what happens when cheap becomes strategic? An electric vehicle today is basically a rolling computer. It's filled with sensors, cameras, GPS modules, microphones, and constant data connections to the manufacturer. These features power advanced systems, from navigation to driver assistance, but they also gather enormous amounts of data. Location and route history, driving habits, voice commands and biometrics, environmental mapping of roads, bridges, and even critical infrastructure. Under Chinese law, companies must share data with the government when asked. That means, hypothetically, if a fleet of Chinese-made vehicles operates in Western countries, the data they collect could end up on servers in China. Imagine that at scale. Real-time mapping of sensitive sites, movement of government vehicles, or infrastructure layouts. It's not a conspiracy theory. It's a possibility that national security agencies in the US and Europe take very seriously. And it's not just about data collection, because every modern EV can also receive remote software updates, meaning they can, in theory, be controlled or disabled remotely. U.S. Commerce Secretary Gina Raimondo even warned, "You can imagine the most catastrophic outcome if you had a couple million cars on the road and the software were suddenly disabled." There have already been reports of security reviews into Chinese-made electric buses and transport systems in Europe and Australia, out of concern that they could be remotely accessed. Even if you buy a non-Chinese car, many of its components, like cellular connectivity modules, still come from China. So the risk runs deep into the supply chain. This is why the Trojan Horse analogy fits so perfectly. The cars are beautiful, efficient, and affordable, but some fear they may carry hidden vulnerabilities inside the gates. Do you see China's EV strategy as smart global competition or something more calculated? Let me know your thoughts in the comments. I'm genuinely curious where you stand on this one. The US has taken a hard line. 100% tariff on Chinese EVs basically shuts them out of the American market for now. It's a defensive move, meant to protect US automakers and reduce security risks. Europe, though, can't isolate itself so easily. Chinese EVs are already gaining serious traction across the continent. The EU launched a major anti-subsidy investigation and concluded that China's automakers do, indeed, benefit unfairly from massive state support. As a result, the EU imposed tariffs between 17% and 38%, on top of the existing 10%. It's not a total ban, but it's a clear signal. We're watching. Of course, China isn't standing still either. They've taken the issue to the WTO and, more importantly, started setting up new factories in Mexico, Brazil, and even Hungary. That means the next wave of Chinese EVs may not even be made in China. They'll be built inside the very markets meant to protect themselves, sidestepping tariffs entirely. That's the genius of industrial strategy. When one door closes, you simply build a new one on the other side of the wall. So, is China's cheap EV strategy a Trojan horse? Well, it depends on where you're standing. If you're a family looking for an affordable electric car, it feels like a gift, a chance to finally go green without going broke. If you're an automaker in Detroit or Stuttgart, it's an existential threat, a state-backed juggernaut dismantling your business model. And if you're a policymaker or national security official, it's a high-tech wildcard, one that could reshape not just the auto industry, but data, infrastructure, and digital sovereignty. China's EVs have already breached the gates. They're on the roads, in showrooms, and in headlines across the world. The real challenge now is figuring out how to benefit from the innovation without surrendering control of the future. Because sometimes the greatest gifts come with hidden costs. If you found this analysis useful, make sure to like, subscribe, and ring the notification bell so you don't miss our next breakdown on the shifting balance of global power. Thanks for watching. Stay curious, stay informed, and I'll see you in the next one.